The global financial landscape is shifting beneath our feet. For decades, the US dollar has reigned supreme, the undisputed king of currencies, the safe haven asset in every crisis. And gold? To many modern investors, it was a relic, a shiny piece of ancient history, sitting idly in vaults while digital markets soared. But the tides are turning. A silent, powerful migration of capital is underway, one that challenges the very foundation of the post-Bretton Woods financial order. If you listen closely, you can hear the quiet whisper of paper dollars being exchanged for the timeless, tangible weight of gold. This isn't a reaction to a single news headline or a fleeting market panic. It is a profound, strategic recalibration by the world's most sophisticated investors. They are reading the macroeconomic tea leaves and making a decisive move. The question for every serious investor today is not whether to pay attention, but which side of this great migration you will be on. This is the story of gold versus the dollar in 2025, a story of debt, de-dollarization, and a duel for the future of wealth preservation. To understand the present, we must first reacquaint ourselves with the protagonists. The US dollar, in its role as the world's reserve currency, is the linchpin of global trade. Most international transactions, from oil to semiconductors, are invoiced in dollars. This creates immense, perpetual foreign demand for the currency, allowing the United States to finance its deficits and borrow money at exceptionally favorable rates, a privilege known as exorbitant privilege. The dollar's value is fundamentally a measure of confidence in the stability of the U.S. government, the independence of the Federal Reserve, the strength of the American economy, and the overall integrity of the financial system. For generations, that confidence has been unwavering. The dollar was the port in every storm. Gold, on the other hand, operates on a completely different premise. It is not a currency issued by any government. It is a tangible asset, a physical commodity with a 5,000-year track record as a store of value. Its worth is not derived from the promise of a central bank, but from its inherent scarcity, durability, and universal acceptability. Gold carries no counterparty risk. It is not someone else's liability. When you hold physical gold, you hold value that exists outside and independent of the financial system. Historically, gold thrives when confidence in that very system erodes. It is the ultimate hedge against uncertainty, inflation, and geopolitical turmoil. It is financial insurance. For years, these two assets have coexisted, often moving inversely. A strong dollar typically meant weaker gold prices, and vice versa. But the dynamic in 2025 is different. We are witnessing a scenario where the long-term drivers for both are accelerating simultaneously, forcing investors to make a critical choice about the ultimate repository of their wealth. The smart money is increasingly leaning towards the metal, and the reasons are multifaceted and deeply interwoven. The most immediate and potent force driving investors towards gold is the specter of persistent inflation. The post-pandemic era shattered the long-standing paradigm of tame consumer prices. While the official figures may have cooled from their peaks, the underlying pressures remain stubbornly entrenched. Supply chain reconfigurations, deglobalization trends, and significant fiscal spending have created a floor under inflation that is structurally higher than the 2% target Western central banks had grown accustomed to. The Federal Reserve finds itself in a precarious position, a veritable trap. On one side, elevated inflation demands higher interest rates for longer to cool the economy and anchor expectations. On the other side, the towering mountain of U.S. national debt, now exceeding $34 trillion, becomes exponentially more expensive to service with every basis point hike. This creates an impossible dilemma. If the Fed remains hawkish to fight inflation, it risks triggering a severe recession and a debt crisis, as the government's interest payments crowd out other essential spending. If it capitulates and cuts rates aggressively to avoid an economic hard landing and ease the debt servicing burden, it risks unleashing a second, potentially more vicious wave of inflation, eviscerating the purchasing power of the dollar. Savvy investors see this no-win situation clearly. They recognize that the path of least resistance for any government drowning in debt is to allow inflation to run hot, effectively devaluing the currency to reduce the real value of its debt obligations. In this environment, holding cash or cash equivalents is a guaranteed loser. The real return, after inflation, is negative. Gold, historically, has preserved purchasing power over centuries. It is the classic hedge against the debasement of fiat currency. When the value of the monetary unit is being deliberately eroded, you want to own the asset that cannot be printed into existence. This domestic challenge to the dollar is compounded by a formidable external force: the accelerated trend of de-dollarization. For the first time in decades, a concerted strategic effort is being made by a coalition of nations to reduce their dependency on the US dollar. This movement is led by geopolitical rivals like China and Russia, but is gaining quiet sympathy from other emerging economies and even traditional US allies who are weary of American financial hegemony and the weaponization of the dollar through sanctions. The BRICS+ bloc, continually expanding its membership, is actively developing alternative financial messaging systems, promoting local currency settlement for trade, and most importantly, accumulating gold at a historic pace. Central bank gold buying has shattered records for 2 consecutive years, and 2025 is on track to continue this trend. Why are central banks, the most conservative financial institutions on the planet, stockpiling gold? Their motives are strategic, not speculative. They are diversifying their foreign exchange reserves away from an over-reliance on U.S. Treasury bonds. They are seeking an asset that is neutral, not tied to any particular nation's political agenda or fiscal policy. This massive institutional buying creates a powerful and sustained bid underneath the gold market, providing a price floor that did not exist to this degree in previous decades. It is a vote of no confidence in the unipolar financial world order and a bet on a new multipolar system where gold will inevitably play a more central role. For the individual investor, this is a crucial signal. When the world's largest financial institutions are moving en masse into an asset, it pays to understand why. Beyond macroeconomics and geopolitics, the investment case for gold has been fundamentally enhanced by financial innovation. The past criticisms of gold that it is cumbersome to store, illiquid, and pays no yield have been largely neutralized. Today, investors can gain exposure to gold through highly liquid exchange-traded funds, ETFs like GLD, which trade like stocks. They can buy digital gold products that represent direct ownership of physical bullion stored in secure vaults, allowing for easy transfer and fractional ownership. Even the yield objection has been addressed through various leasing and savings platforms that allow gold holders to earn a return on their metal. This modernization has removed the friction that once kept gold on the sidelines of many portfolios, making it as easy to trade as any tech stock while retaining all its unique, non-correlated safe haven properties. This is not to say the dollar will simply vanish overnight. That is a hyperbolic and unrealistic scenario. The dollar's network effects are profound, and there is no clear single successor waiting in the wings. The U.S. economy, despite its challenges, remains the largest and most innovative in the world. The dollar will likely remain the primary reserve currency for years to come, but its dominance is unquestionably diminishing. The monolith is cracking. For investors, this doesn't mean a binary choice, but a strategic rebalancing. So, where are the smart investors moving now? They are not abandoning the dollar entirely. That would be imprudent. Instead, they are strategically allocating a significant portion of their portfolio to gold as a core holding, not a speculative trade. They are moving from financial assets, which are claims on future cash flows and carry inherent risk, to a tangible asset that is a store of value itself. They are recognizing that in a world of heightened geopolitical risk, currency debasement, and shifting alliances, gold represents the ultimate form of financial sovereignty. It is insurance against systemic risk, a policy that pays out precisely when traditional assets are failing. The great monetary migration of our time is not a rush for quick profits. It is a flight to safety, permanence, and rationality. It is a recognition that the assumptions underpinning the last 40 years of investing, the ever-expanding debt, the tame inflation, the unchallenged dollar supremacy, are no longer reliable guides for the future. The smart money is moving out of confidence and into certainty, out of promises and into value, out of the digital ether and back into the tangible, immutable reality of gold. The writing is on the wall, etched not in ink, but in the timeless glow of the one asset that has outlasted every empire, every currency, and every financial crisis in human history. The prudent investor's task is to read it, understand it, and act accordingly. The dialogue between gold and the dollar is the oldest conversation in finance, a debate between trust in man-made systems and trust in immutable scarcity. In 2025, that conversation has reached a crescendo. The choices made by central banks, institutional funds, and individual investors today will define their financial resilience for the next decade. This is not about predicting the next quarterly earnings report. It is about navigating a fundamental regime change in the global financial order. The dollar, burdened by debt and political division, is showing its cracks. Gold, eternal and apolitical, is waiting in the wings, not as a replacement, but as a necessary balance. The smart investors are those who have already stopped seeing this as a debate and started seeing it as a diversification imperative. They are moving to solidify the foundation of their wealth with the one asset that requires no promise, no counterparty, and no permission to hold its value. They are moving, quietly and decisively, into the steadfast security of gold, ensuring that no matter how the winds of the global economy shift, their anchor will hold firm,